5 financial decisions that can make you rich. What separates someone who retires wealthy from someone who works paycheck to paycheck for life? It's not luck. It's not having a 6-figure salary. And it's definitely not buying lottery tickets or chasing the next viral crypto coin. In reality, wealth is often the result of just a handful of financial decisions made consistently over many years. Today, we're breaking down 5 financial decisions that have created more millionaires than any get-rich-quick strategy ever has. These are the same principles used by successful investors, entrepreneurs, and financially independent people around the world. If you're serious about building real wealth, not just looking rich, watch until the end. Let's begin. Decision number 1. Pay yourself first before anyone else. Here's a question. When your paycheck arrives, who gets paid first? Your landlord? Your bank? Your credit card company? Your streaming subscriptions? For most people, the answer is everyone except themselves. The wealthy reverse this order. Instead of saving whatever is left over, they save first and spend what's left. Financial experts often call this the pay yourself first principle. Here's how it works. The moment you receive income, automatically move a percentage into investments or savings before paying bills or making purchases. Why? Because humans naturally spend what's available. Behavioral economists call this lifestyle inflation. As income increases, spending usually increases with it. That's why many people earning $100,000 per year still struggle financially. Meanwhile, someone earning half that amount can quietly become wealthy simply by consistently investing. Imagine investing $500 every month with an average annual return of 10%. After 30 years, you'd have accumulated well over $1 million thanks to compound growth. Not because you earned millions, but because you consistently invested. The biggest mistake isn't investing too little. It's waiting too long to start. Every year you delay gives compound interest less time to work. Time, not timing, is the real superpower. Decision number 2. Buy assets, not liabilities. One of the most important lessons in personal finance is learning the difference between an asset and a liability. An asset puts money into your pocket. A liability takes money out. Unfortunately, many people buy liabilities believing they're assets. A luxury car loses value every year while costing money to maintain. The latest smartphone becomes outdated within a few years. Designer clothing rarely increases in value. On the other hand, real assets can generate income or appreciate over time. Examples include broad stock market index funds, rental real estate, profitable businesses, intellectual property, dividend-paying investments. Notice something? These assets can continue making money while you sleep. That's exactly why wealthy people focus on owning productive assets. This doesn't mean never buying things you enjoy. It simply means buying assets first and luxuries later. A good rule is, if it doesn't increase your income, reduce your expenses, or grow in value, think twice before calling it an investment. Financial freedom comes from owning things that produce cash, not things that consume it. Decision number 3. Invest consistently instead of trying to predict the market. Many beginners wait for the perfect time to invest. They wait for markets to crash. They wait for interest rates to fall. They wait for the next big opportunity. The problem? Nobody consistently predicts the market. Even professional fund managers struggle to outperform the market over long periods. Instead, many successful investors follow a strategy called dollar-cost averaging. Rather than investing one large amount at once, they invest a fixed amount regularly. Every month, every paycheck, every year. When prices fall, they buy more shares. When prices rise, they buy fewer. Over decades, this reduces emotional investing and removes the pressure of trying to time the market. History shows that despite recessions, wars, financial crises, and market crashes, diversified stock markets have generally trended upward over long periods. The lesson isn't that markets never fall. The lesson is that disciplined investors stay invested. Fear causes many people to sell low. Patience allows wealth to grow. Time in the market usually beats timing the market. Decision number 4. Increase your income instead of only cutting expenses. Saving money matters, but there's a limit to how much you can save. There's no real limit to how much you can earn. Many people spend years trying to save an extra $50 each month. Meanwhile, they ignore opportunities to increase their income by hundreds or even thousands. Wealthy people often ask a different question. Instead of asking, "How can I spend less?" they ask, "How can I become more valuable?" This might mean learning high-income skills, starting a side business, building digital products, negotiating a higher salary, freelancing, creating online content, or investing in education that improves earning potential. Income is one side of the wealth equation. Investment is the other. The more income you generate, the more capital you can invest. Think of it this way. You can only cut coffee expenses once, but you can increase your earning ability for decades. Your greatest financial asset isn't your house. It isn't your car. It's your ability to create value. Protect it. Improve it. Invest in yourself continuously. Decision number 5. Think in decades, not days. Modern culture rewards instant gratification. One-click shopping, fast delivery, instant entertainment. But wealth works differently. Real wealth usually grows slowly. Many self-made millionaires didn't become wealthy overnight. They invested consistently for 20 or 30 years. Business owners often spent years building companies before seeing major success. Long-term thinking changes everything. Instead of asking, "How much money can I make this month?" ask, "What financial decisions will improve my life 10 years from now?" Should you invest today? Should you learn a valuable skill? Should you avoid unnecessary debt? Should you build multiple income streams? Small decisions, repeated over decades, create extraordinary results. Compound interest doesn't just apply to money, it applies to habits. Good financial habits compound. Bad financial habits compound too. Every dollar invested today becomes your employee. Eventually, your investments begin earning more than your job. That's when financial freedom starts becoming reality. Final thoughts. Let's quickly recap the 5 financial decisions that can genuinely build wealth. First, pay yourself first. Second, buy assets instead of liabilities. Third, invest consistently rather than trying to predict the market. Fourth, increase your earning power. And finally, think long-term. Notice something? None of these ideas promise instant riches. That's because real wealth rarely comes from shortcuts. It comes from disciplined decisions repeated over many years. The good news? You don't need to be born wealthy. You need a perfect economy, and you don't need to predict the next stock market winner. You simply need to start making better financial decisions today than you did yesterday. Your future wealth depends less on one big decision and more on thousands of small ones. Thanks for watching. If you found this video valuable, leave a like, subscribe, and share it with someone who wants to build lasting wealth. And remember, the best financial decision you'll ever make is starting before you feel ready.